Good morning, everybody, and welcome to Tuesday Training. I hope you're having a fantastic week. As always,
we are live from Austin, Texas, right here at Insurance Syndicate headquarters. And man, we have a great show for you.
Good morning. Happy Tuesday, everybody. Hope you all are doing fantastic. Got a solid show lined up for you as always, talking about the Medicare space. Man, we're going to talk about some new news, a little bit of new news that's in there. I've got a couple of news updates, and then we're going to kind of pick up from the trend the last couple of weeks, talking about some of the challenges that are happening in the Medicare space, particularly in the Medicare Advantage market, as we all prepare for AEP. And then we're going to finish the show with a playbook for the independent broker, thinking about some of the challenges that are going on in the Medicare space. I know there's a lot of different agents out there, different types. I've been in this business for 21 years. There's agents that want to work by themselves. They want to be an independent broker in their local community. They're not looking to scale something massive. And then obviously we have large groups that are looking to scale massive things. They all have their own different challenges, desires, goals, dreams, etc. And we're going to take a look at some of that at the end with some playbook stuff, things that you can do to maintain relevance in today's market and continue to grow your business in the fashion that you want to grow it. So stay tuned for that. We're going to close out the show with that playbook, but we are going to jump into some news here in a minute. As always, this show is brought to you by DFY CRM, my CRM of choice. I absolutely love it, man. And we are doing some really good updates in our own build out, snapshot, whatever you want to call it, inside of the DFY platform. I actually have a meeting coming up tomorrow. Yeah, tomorrow, if I remember correctly, with Tim James and Eric Fierro. We're going to talk about some things that I want to include, add, expand from my own thought processes in their CRM. So we will do our best to make that available to anybody that's in the DFY world. So get excited if you're out there looking for a CRM. And man, if you don't have one, that's a problem. I talk to agents all the time. They're like, CRM, I don't have a CRM. I'm still using an Excel spreadsheet or a piece of paper or whatever it is. And it always blows my mind. But anyway, if you're looking for a good CRM, looking for some updates, give DFY a call, check them out, and they will definitely get you a demo. But I want to just jump right into some basic news stuff. I got a couple of simple articles, a couple that are pretty interesting, and then we're going to get into kind of more of the crux of the show. But picking up right quick, let me just share my screen real quick for you guys. Boom. Just dropped just recently. This is out of Fierce Healthcare. Nothing serious, but HHS, right, which is the Department of Health and Human Services, they are forming an outside committee to learn about reshaping Medicare and Medicaid, and they are looking for professional help. Says right here in the article that the Department of Health and Human Services will seek external experts for a new committee tasked with providing strategic guidance on the care provided by government insurance programs. On Thursday, it was announced that the Healthcare Advisory Committee will offer recommendations to Secretary RFK and CMS Director Mehmet Oz, or Dr. Oz, seeking to improve how care is financed and delivered across Medicare, Medicaid, the Children's Health Insurance Program, and the Affordable Care Act exchanges. They are accepting nominations for committee members and looking for experts in chronic disease management, financing, and federal health programs and delivery system reform. Individuals can be nominated by an organization or submit a nomination themselves. Going a little further, it says here that the announcement outlines several key focus areas for which the committee will develop recommendations. For one, it will be tasked with creating actionable policies to promote chronic disease prevention and management. In addition, it will seek to establish a regulatory framework that promotes patient safety while reducing unnecessary red tape. The committee members will also work to advance a real-time data system that allows for faster claims processing and quality measurement. And then finally, they will examine, here's the big one, they will examine the sustainability of Medicare Advantage building a more modern approach to risk adjustment and quality measurement in the program. If you know any people that you think might qualify, nominate them. Nothing major there, but I thought it was interesting. They are seeking some outside counsel and building a committee to try to further correct the correction that's happening right now, which we're definitely going to talk about some more. Moving along, we got a new bill that's getting ponied up to stop the blocks that would be coming to home health care. Now, if you haven't seen a while back, let me actually jump to that first. This was released back in June. The CMS proposal for cuts to home health care. I am not going to go through this whole thing, but basically on June 30th of 2025, right here at the top, it says that CMS issued a proposed rule that proposes updates to Medicare payment policies and rates for home health agencies. This was under the Home Health Protective Payment System, calendar year 2026. If you go through it, pretty simple. Right here is the highlighted part. CMS estimates that Medicare payments to home health agencies in calendar year 2026 would decrease in the aggregate by 6.4%, or $1.135 billion with a B. So home health care agencies are looking at a massive pay cut, but going back, a new bill would block Medicare home health care cuts for 2 years. On Thursday, lawmakers introduced a bill, and this was a bipartisan bill. There was a Republican and a Democrat that got behind it, put it up there. I always like to see bipartisan stuff. I feel like that shows that both sides are working together to try to create solutions. But nonetheless, the bill, called the Home Health Stabilization Act of 2025, is designed to stabilize home health payments and guarantee patients access to care that allows them to age in place. Specifically, the bill would require the Secretary of Health and Human Services to apply a positive payment adjustment to offset the negative payments that were included in that proposed rule I just mentioned. So again, they are proposing a 6.4% aggregate cut. And this bill is saying, no, let's not do that. Let's create some offsets to prevent that. It doesn't get super deep in the offsets. There's not much other info in that. This just got put up on the Hill, but they are looking at basically stalling or impeding those payment cuts. And I've mentioned this before. While all of that information has not been released, we already know that they're slated for about $500 billion in cuts to Medicare over the next 10 years. So an average of $50 billion, which based on our current Medicare expenses is somewhere around, what is that, maybe 5%, 4% in cuts, truthfully, because when we're already spending over $900 billion a year, we actually in 2024, I just pulled it up and actually pulled that slide from Kaiser, talked about this last year. We're already over $1 trillion. We spent over $1 trillion on Medicare in 2024. So 50 billion isn't massive, but where I'm going with that is my understanding from what I've read so far on the direction that they're looking at those cuts, they're all in the provider space, right? These aren't necessarily benefit cuts to seniors. They are provider cuts. And here's one of them right here that they're talking about in these home health care agencies. So this new bill is getting put up. We'll see how it goes. And that could certainly block those cuts, or again, create an offset where maybe instead of getting the whole 6.4% aggregate cuts, maybe it's, only a couple of percent and it's not as damaging. We shall see. Moving along. This one I thought was pretty interesting because this has been an argument that's been going on for a while. A lot of people have been saying that, hey, this growth in Medicare Advantage has been creating a lot of pressure on hospitals, particularly rural hospitals. Well, MedPAC says no, that's not true. That what we're finding is that is actually not correct. There's a whole other set of complications and problems that are creating these unprofitable situations for some of these rural hospitals. And it says right here in the headline that Medicare Advantage enrollment increases in Medicare Advantage enrollment are not tied to worse hospital margins, which some people have been arguing for a bit. So I'm going to pick through some of this for you and read some highlights. But it says that increases in Medicare Advantage enrollment are not, on average, associated with significant profit margin changes for hospitals operating in their respective counties. And again, this is according to an analysis conducted by Medicare Payment Advisory Commission, or MedPAC. And this was reviewed by commissioners last Friday. The analysis, which examined all payer revenue, cost, and profit margins pulled from hospitals from 2013 to 2023, Medicare cost reports, pushes back on hospital groups' claim that the rising number of MA enrollees brings tighter margins and threatens their financial viability. Rather, MedPAC found that MA enrollment increases were tied to lower revenues and cost alike. Specifically, a 10 percentage point increase in a county's MA penetration, right? Say that again just to make sure that's sunk in for you. A 10 percentage point increase in any given county's MA penetration was associated with about a 1.3% reduction in all payer revenues and a 1.2% reduction in all payer costs. So they're saying that it's not costing them more money, it's costing them less. The resulting 0.1% dip in profit margins was not statistically significant. Going on, it says the analysis found that hospitals that are financially integrated with a Medicare Advantage plan, right, for example, like common ownership, did not have a significant change in revenues or cost with higher enrollment. All right, which again, they had suggested could stem from limited incentives for plans to reduce these hospital volumes. Critical access hospitals also had no significant changes in revenues, cost, or profit margins due to Medicare Advantage enrollment changes, potentially due to their cost-based reimbursements that would rise with lower volumes. The commission noted that a shift in enrollment rates could have a downstream effect on the add-on payments that some hospitals receive to offset their uncompensated care. And that's due to payment formula sensitivity or changes in total MA discharges versus fee-for-service discharges. I thought that was pretty interesting, right? And you can go through this. It goes through the analysis. I'm not going to go through the whole thing, but I'll put this article in the group. You can get to the full analysis and also some anecdotal accounts that they bring up and use as references. But pretty interesting that there's been a lot of argument, right, that says that, hey, this massive spike in MA has created downward pressure on rural hospitals. And according to MedPAC, that is absolutely not true, right? They can't blame or point the finger at Medicare Advantage for these problems. They have their own set of problems that they're dealing with that are creating that. So another one real quick, and then we'll jump into the crux of the show. This one, it kind of fits in. Like most people are going to tell you if you've done some research, and I think Kaiser Family Foundation said specifically that Medicare Advantage costs Medicare, or the federal government, or i.e. taxpayers, roughly 22% more than original Medicare. That's not what this article says. You can find that Kaiser article. I've put it in the group before. This was another article that I brought up when I was doing my CE class for Medicare back in Dallas recently for their NABEP event. And this article talks about hospital stays, which supports that claim that Medicare Advantage costs taxpayers or costs federal government more money than original Medicare. And a big part of that, like, let's just be honest, original, and I've talked about this many times, and it's been happening since pert near 97, reimbursements to providers under original Medicare is going down, right? Reimbursements to providers on Medicare Advantage in a lot of areas is going up. So that alone should tell you that, hey, original Medicare doesn't cost the federal government or taxpayers as much because providers make less money in general. This article again supports that because it's saying that Medicare beneficiaries experience longer average hospital stays compared to traditional Medicare recipients. How much? Well, it says here, again, Medicare Advantage beneficiaries experience disproportionately longer hospital stays compared to traditional Medicare beneficiaries, according to an investigation published in the Journal of American Medical Association. The study examined more than 89 million hospitalizations since 2017 to the third quarter of 2023. The adjusted analysis were conducted on a 20% random sample with subgroup analysis of patients discharged to skilled nursing facilities. Primary outcomes included the length of stays in days and indicators for extended stays, such as more than 7, more than 14, 21, or 28 days. The sample also included short stay inpatient admissions to United States acute care and critical access hospitals, and the data was analyzed from June of 24 to June of 25. Over that study period, the mean length of stay for Medicare Advantage admissions increased from 6 days to 7.1 days, compared with an increase from 5.8 to 6.3 in traditional Medicare. So just to kind of hit that last point again, they're saying that hospital stay admissions under Medicare Advantage went from an average of 6 days to 7.1. So they gained a full 1.1 days. I think that's like a little over 18%, compared with an increase of 5.8 to 6.3, which is not even, that's maybe 1%, if my math is correct. So additionally, MA admissions were 1.2% more likely than traditional Medicare admissions to last 14 or more days. It's not a huge difference, but it is a difference, especially when we're talking about 89 million hospitalizations. Among those who were discharged to skilled nursing facilities, the adjusted probability of Medicare Advantage admissions lasting 14 or more days increased by 3.1%. In 22 alone, prolonged stays among MA patients accounted for an estimated 1.8 million additional hospital bed stays, equivalent to 288,000 additional admissions with the average length of stay. Fairly simple. So that's kind of the crux of the article, just saying, hey, if you're on a Medicare Advantage plan, right, and we're talking about the collective of all Medicare Advantage enrollees, they are more likely to have a longer hospital stay than original Medicare, which would be contrary, I think, to what a lot of us believe. A lot of us think that, hey, as soon as they're in there with it, like they want to get them the hell out. If they're on a Medicare Advantage plan, like, boom, let's get them out, right? Especially maybe after they meet their, what's the word I'm looking for? Their deductible period, so to speak. And I'm kind of wondering if that might be part of it, as an example, right? If you have someone that has Medicare supplements with original Medicare, they're not going to pay anything when they go in the hospital, right? It's all covered. So is it perhaps that Medicare is pressing the hospital to, hey, let's get this person healed up and out the door quicker? And are the hospitals milking Medicare Advantage and the copayment by getting that extra day on there? Possibilities. But again, it does support the argument that Medicare Advantage does cost taxpayers more, but it kind of goes against a lot of our thought process that if you have a Medicare Advantage plan, you're not going to get as good of attention as you would under original Medicare. And so it's kind of argues against both of those, in my opinion. But moving on, man, let's get to the crux of the show. Yesterday, let me get this on here. Boom, boom, boom. Yesterday, my buddy Justin Brock, I'm not going to share this, but yesterday, my buddy Justin Brock made an interesting post in the Medicare Monsters group. He's spot on. I say interesting, but it's spot on. And I love Justin to death. He can certainly be a little direct, not that I can't, and a little maybe harsh. And it's a little savage. But his post said, nothing screams, I'm not a real business owner, like whining on Facebook about ethics of compensation shifts after a decade bull run in your market. And I do tend to agree with him. For the last 10 plus years, we have had a massive bull run in the Medicare space, especially in the Medicare Advantage world. I've talked about this many times. If you go back to 2014, the original proposed rule that year for Medicare payments was to be a decrease in the subsidy to Medicare Advantage plans. But then in the last minute, they flipped that and gave Medicare Advantage plans one of their very first large increases in subsidy. And in 2014, Medicare Advantage, like there was maybe 9 people on a Medicare Advantage plan. There wasn't that many. I'm exaggerating a little bit, obviously, but penetration of Medicare Advantage was very, very, very low in 2014. That was pretty much ground zero of that bull run. So he's spot on, like after a decade bull run, 100%. You go back to 2014, that was the first increase they got, and increases to Medicare Advantage plans have happened every year since 2014. The subsidy continues to get bigger. The plan footprints got bigger. Supplemental benefits got bigger. Like everything went crazy. It was getting better and bigger and greater and huge. And now here we are, and that bubble is popping to some level, and we're due for a correction. We're due for a correction. There's a lot of people that are complaining about that correction because that correction involves plan exits. That correction involves lower commissions in some areas on some products, or no commissions from some carriers on products. I haven't had a chance to prove it myself, but I can't imagine this is false. It came from a good source, but supposedly here in Texas, Blue Cross is not going to pay commissions on their Medicare Advantage plans for 2026. I have not had a chance to get into those details, but again, I'm already hearing that from multiple sources. Pretty wild, right? But there's a huge correction now, and you can look at any point in history of any giant bull run, any bubble, any market that grows. It always reaches a point where it has to correct, turn back down, consolidate, reform before it can grow again. Our market is no different. We saw it back in the 2000s with the internet. We've seen it over and over and over again with the real estate markets. Look at cryptocurrency, any investment vehicle, everything goes up and up and up and up until it hits a critical axis or a critical stage, and then it has to turn back and consolidate and correct. And that's 100% where we're at. And as an agent, you can whine about it, or you can figure out what you need to do to capitalize on it, because we're not going anywhere. Like, as an agent base, as a group, as a collective, we're not going anywhere. I mean, unless you choose to leave for your own purpose. But there's massive opportunity still existing, right? We're at that critical juncture where we need stronger thinkers, better folks to get involved and help us move this correction back in the positive direction, which it's going to very, very soon, I believe, right? We're just in that space right now where some people get upset, and there's corrections. Some people are going to lose, some people are going to capitalize and win, but you're going to have to learn to create a mind shift for yourself. And that's where I'm going to get to towards the end of what I was talking about with the playbook that I'm going to bring out for you guys. So you can kick your feet, whine and scream all you want, but it's not going to all of a sudden make Blue Cross or any of the other carriers start giving you what you want in commissions and fat payments, etc. I mean, in general, for Medicare Advantage plans, we all got an increase. We got the biggest raise we've ever gotten. Up now, we're making $694 an app. No offense, but that's pretty obscene if you ask me. I'm going to take it, believe me, and I get better than that because I have better contracts, but still, like, we're still getting more money. It's just coming from less carriers. So I'm going to hit you with some more sky is falling news for a second, and then we're going to jump into the playbook that I wanted to talk to you guys about. We're going to look at it from a couple of angles, but you may have seen this. Let me get this on the screen for you. Boom, shakalaka. The bad hits keep on coming. Elevance is out. At least not out. And you may have already seen this, but this is another giant exit in the Medicare Advantage space. Elevance cuts their MA footprint, exits the standalone drug market altogether. Roughly 150,000 individual and group MA members will be affected by their plan exits, as will around 400,000 Part D enrollees. Now, if you were with me last week and the week before, this is kind of the topic that I've been going along a little bit, has been the changes, the reductions in footprint plan exits, right? Last week, I talked about United Healthcare. They're going to lose about 600,000 members. Humana is going to lose about 500,000 members. Aetna is going to lose about 400,000 members. Those are their own projections. That's not information that was whittled out of thin air. That is coming directly from the horse's mouth. United Healthcare is saying we're expecting to lose 600,000 members. Humana is saying we're expecting to lose 400,000 members, or 500, and then Aetna 400. Elevance is going to drop about 150,000 just in the MA space. So I had mentioned that my projection was there's probably more than 2 million people this year that are going to lose their Medicare Advantage plan by no fault of their own. Every year we get about 1 million people that lose their Medicare Advantage plan by no fault of their own. This year it's just bigger, a lot bigger. And I think it's going to be a good size over 2 million, because just the top three carriers, again, UHC, Aetna, Humana, that's 1.5 million right there. Elevance is going to drop about 150,000 with some plan exits and reduction in footprint. And then again, they are exiting Part D market 100%. Jumping in here just a little bit, hit a couple of high notes. Elevance is trimming its Medicare footprint, especially in PDPs. The insurer is exiting the Medicare Advantage plans where long-term economics are not sustainable. And the part that bugs me about this is agents get all up in arms and they're like, oh, Elevance, they're sticking it to us. They're not paying commissions, they're pulling plans, whatever. They'll say things like that, but it's just not, that's not the case. It's a situation where they're, just like it said, long-term economics are not sustainable. If you're in a business and your long-term economics are not sustainable, hopefully you're going to exit that business or pivot or find some way to fix it for you. And again, we're going to talk about more of that. But again, like here's another example that leads up to my prediction that around 2 million or more people are going to lose access to their plan. Elevance is making a massive change here. So going on, it says that their decisions were not made lightly, but would ultimately help them exit 2025 on firmer footing. So again, it's just an example. They're trying to consolidate, put themselves in a better position to regrow in the following years with firmer footing, right? And here's another throwback to what I said about UHC. Right there, UHC, the largest insurer, particularly aggressive. They intend to exit plans that currently serve more than 600,000 members. So there's going to be some massive exits this year. We're going to have way more people than normal that lose access to their Medicare Advantage plans. I talked about this last week in my kind of AEP prep up. Like, are you aware of this? Is it happening in your marketplace? Have you looked at how you can address those changes? Do you know what the rules of the game are when it comes to someone losing their plan involuntarily? Are you prepared for that? Are you targeting marketing in those areas where people are going to experience plan exits so that you can go in there and scoop up some of that business? Right? Let's hit it again. We ain't done yet. Here's another one. UCare exiting Medicare Advantage 100%. This is out of Modern Healthcare. UCare is a large, they're up in the north, mainly Minnesota, but also Wisconsin. But as it says right, they're a nonprofit carrier, by the way, and they can't even make it work. Profitable carriers are exiting for obvious reasons, but now we even have a nonprofit carrier. It's like, shit, we're not even trying to make a profit. We can't make it work either. But as of August 1st, the nonprofit carrier had 186,700 Medicare Advantage members across Minnesota and Wisconsin. A 31% growth from this last year. So again, if we're not, let's be real about what's going on for a second. They had 31% growth from the previous year, and now they're having to exit. That's all of that is based on, for the most part, that's all based on regulatory changes, right, and regulation that's come down against these carriers and so forth and what they're doing. But yes, there's another 186. Boom. And again, they love to hit it. In here is United Healthcare dropping 600,000. But there's another carrier. They are completely leaving the business. That's not that they're just shrinking. They are exiting 100%. As a nonprofit, they will not be in the Medicare Advantage space next year. So if you're up in Minnesota, if you're up in Wisconsin, and you've been selling UCare, it's gone. You ain't going to see it next year. Maybe they can find a way to get back in the game, but that is it. So there's not much more to say about it, but they also eliminated 88,000 enrollees actually this month on Medicaid plans. Wow. They stopped paying third-party marketers commissions for enrolling new members in MA plans, and they laid off 80 employees, or about 5% of its workforce. So another big hit as part of this whole movement that we're going on with. But again, if you're up in Minnesota, Wisconsin, there's one that's going to hit you. But with all of this negativity, with all of this sky is falling type news, here we have this guy. Independent broker Andrew Flitner. He's expanding his business. So this is the dichotomy in thought processes. You have some people that are looking at what's going on in our space, and they're like, oh, time to get out of the Medicare world. It's falling apart. And then you have other people that realize that, hey, this is going to be a great opportunity because if I can sustain and get through this, there are going to be a bunch of agents, a bunch of agencies, call centers, FMOs, et cetera, that are going to stumble, that are going to lose market share, that are going to exit the business as well because it's getting a little bit harder, right? It's just getting harder. That's really all it is. So, but in all the negativity, everything I've been talking about, plan exits and commissions and yada, yada getting pulled, this dude's like, no, let's go. Let's grow, right? So he and his wife, Stephanie, it says here, who run their business together, were looking for a new location because they outgrew their previous location and they wanted to stay close to their Carmel home. So they moved Flittner's Independent Senior Insurance to a new location, and they spent $1.2 million on the renovation of the Carmel location, which celebrated its grand opening back in August of 22nd. So what does this guy see that nobody else sees? Why is he willing to go drop $1.2 million to renovate a new office in the Medicare space when so many people are saying, oh, no, don't get in the Medicare world right now. It's blowing up. It's just making changes, man. It's just making changes, which means you have to change too. So with that said, I wanted to jump into kind of a playbook, so to speak. So I'm going to go through a few items. This shouldn't take too long. We'll have a little shorter show today. But I want to go through, number one, some of the trends that are shaping our industry. We talk about them a lot. I hit them on in different spaces, but I kind of bullet pointed some of this down for you that I want to go through. And then we're going to talk a little bit about, hey, what's it like as if I'm an independent agent and I'm not trying to scale something massive like what Justin Brock's done, like what some of these other folks have done. I just want to be an independent agent, man, and make a living and be able to pay my bills and enjoy my independent lifestyle. What does that playbook look like given the challenges that are going on right now? So we're going to talk about some of that. But first, and hopefully maybe you got a pen handy real quick or just pay attention, but what are some of the trends that are shaping the future of our business right now? Well, we have Medicare Advantage dominance and market complexity, right? 54% of people are enrolled in Medicare Advantage plans as of 2024, which is wild because if you go back to original projections from a few years ago, it will tell you that they weren't expecting to cross the 50% penetration threshold until 2030. But we beat it 6 years ahead. They also weren't expecting us to spend $1 trillion on Medicare in a year until around 2030. Well, we hit that last year as well. So as of 2024, we've already crossed thresholds that weren't projected to hit until 2030, right? We've already crossed where Medicare Advantage is the dominant delivery system for healthcare in the Medicare space. We're at 54% penetration. Probably going to peel back a little bit this year. Let's be honest, right? We'll probably see that maybe go back to 52%, 51, maybe, I don't know. And then we're over $1 trillion. So Medicare Advantage dominance and market complexity, that is one of the biggest trends that is shaping our future, right? We have enrollment complexity, plan proliferation, and abundant supplemental benefits are making plan choice more challenging, and it's boosting the need for knowledgeable brokers. Number two, competitive pressure from digital-first agencies. And this is why I said I wanted to build my playbook out that I'm going to talk about in the last few moments of the show based on, hey, I'm not trying to be the digital-first agency. I just want to be Johnny Broker in Timbuktu, Michigan, or wherever that town is at, and serve my community and make a good living for myself. How can I do that in today's environment? And again, we're going to hit on that. But this is a big part of it, right? This is a huge trend. You're up against competitive pressure from digital-first agencies. Technological evolution is reshaping the distribution space. Independent agents you're facing more and more competition from digital-based agencies like mine, right, that are in a telesales space where we're marketing digitally and we're selling through automations and telesales environments, right? We work in 35 states. I get it. So we're leveraging those items. And if you're an independent agent and you're like, hey, I'm still kind of old school and I'm working in my backyard, that's going to create a lot of pressure for you, a lot of competition. And then you have the Medicare eligible population that is expanding super fast We're going to have over 80 million of them by 2030, and their adoption rate of technology is a lot faster than what I think some of you believe. I think there's still a group of agents out there that are like, no, you can't sell by phone to old people. Old people aren't going to fill out an online retire flow intake form with their bullshit. Bullshit. They are. 98% of our traffic in our agency comes through on smartphone. And they all go through our appointment link process, and they all go through our retire flow process right there on their smartphone, right? So understand that agencies that are utilizing and leveraging automation and AI and digital marketing tools, they're going to create a lot of pressure for you if you're just the independent guy still knocking on doors or doing direct mail and some of those things in your local neighborhood. Number 3, and again, these are trends that are shaping the future. Regulatory and oversight dynamics, right? And then there's a report that was led by Senator Wyden. I'm not sure what state he is in off the top of my head, but he calls for reforms in MA marketing, right? We've already know about some of the reforms that they've ponied up, some that are happening, some that are not. But that includes requiring brokers to adopt fiduciary responsibilities, possibly implementing fixed fees, and granting CMS more authority over our marketing practices. So when you look at all of the regulatory oversight, that is creating downward pressure on us to better dot our I's and cross our T's, so to speak, right? And that doing that at a very high level, that costs more money. You got to buy more systems. You got to get telephonic recording systems if you sell anything by phone at all. Like there's all these other things that do increase our cost of doing business, right? Because of these regulatory oversight. So that kind of gives you an example. Number 4, legal challenges, customer trust concerns. I don't know if this is as big a concern or not for us, but maybe it is, right? Maybe it is, but there are legal concerns, and I'm not necessarily talking about the greedy lawyers that are out there finding agents that are maybe accidentally abusing TCPA violations, or maybe they're accidentally, like we have the new text message thing coming out in Texas that requires everybody in Texas, if you're doing automated text messaging, text marketing, or sales messages, like I want to be real clear about that. If you're in Texas and you're selling by phone or you're using automated messaging, I would look really, really, really hard at that rule that's saying that you need to spend $10,000 and make a deposit as kind of a surety bond, so to speak, in case they catch you breaking the rules later. I am not a lawyer. I have run it by some lawyers, and our assessment, just going to say it, was that unless you're sending out automated text messages where you don't already have PTC, and those messages are sales related or marketing related, then you absolutely need to pay that 10 grand. If, on the other hand, you're only ever sending automated, right, not manual, automated text messages to your prospects or clients that are service oriented. Hey, Judy, I wanted to remind you of your appointment coming up. I'll see you at 10. Those types of messages, you do not need it. Okay. That is my understanding based on a couple of attorneys that I showed it to and talked to about it. Get your own legal advice and figure out if you need it. But those are challenges, right, that are happening. Things like that, those legal challenges are an issue, right? On top of the legal challenges at the higher level with the Justice Department suing carriers and big brokers that are out there, right? There's a massive lawsuit going on between SelectQuote, Aetna, Humana, eHealth, GoHealth, right? Things like that are a big trend, a big issue that are creating problems in the industry, right? So again, right now I'm just talking about trends that are kind of shaping our future. The 5th one is renewal opportunities for us as advisors, right? The recurring renewal model in MA and Medigap is creating problems because we have areas where commissions are becoming an issue, where maybe you're no longer going to get renewal commissions on this, or maybe renewal commissions are dropping, or maybe that plan is exiting, so it's not as easy to capture the renewals because now you have to move them if you can even get them back on the phone after they lost their plan, right? So these are some of the different trends. Now, if you're an independent broker, what does that mean? Well, it means that expertise matters. There's hundreds of plan choices. There's problems amuck with carrier exits, shrinking markets, shrinking footprints. So brokers who can provide clarity and personalized support are the ones that are going to retain their value and thrive, right? So you need to figure out a way to build trust via continuity by maintaining ongoing engagement with your clients and build that client loyalty, right? So again, your challenges you're looking at regulatory scrutiny. We already know about. The bigger you are, the more scrutiny you're probably going to have. You have digital disruption that's going on from telebrokers, online brokers, because you don't have to be a select quote anymore, right? You can be Johnny Agent sitting in a room with a couple of your buddies, and you're really good at SEO, or you're really good at social media marketing, and you're really good at sales by phone. And we can create that same type of pressure on the independent broker in their market. And then certainly reputation risks because of all these lawsuits. So if we're looking at a road ahead and you are an independent broker, right? You're not trying to scale a massive business. What is a roadmap, or what is a playbook for you? And here I've got 7 points that I want to run through with you. If you are that person, if you are that independent broker working in a local area, and that's the model you want to continue. I want to continue running my game in my local area and be the guy. Here's 7 points that are going to help you get it done. I would write this stuff down. Number one, and some of this is going to be redundant. I guarantee you, most of what I'm going to tell you about is not brand new, earth-shattering news. This is stuff you've probably been told if you've ever been to an event and somebody talked to you about what are the things you got to do to grow your business or maintain your business. A lot of this is going to be redundant, right? But maybe it'll hit you. Number one, you got to position yourself as the local trusted Medicare advisor, and you want to lead with personal relationships over volume, right? We're in a telesales environment here at Avila Medicare. It's not that we don't value personal relationships, but volume is a big part of our play, right? We have a very high touch model, but again, volume is the big play here. But if you're a local guy and you're working just your local market, then you have to really pour into personal relationships, because you are truly looking for long money through renewals and relationships and opportunities versus just, hey, let's get some quick, short volume money, right? So you need to focus on building deep trust with a manageable client base rather than chasing thousands of leads, right? We pull in probably 250 leads a week in this office, not including inbound phone calls. And we're chasing those. We're going after those, right? They're low intent leads. We're only closing a very small percentage of them. When we close them, we're very high touch on the client base. But if you're going to be the local guy in just your area and try to build up your name as the go-to trusted Medicare advisor in Timbuktu or Tupelo or wherever it might be, you're really going to have to focus on building deep trust with a manageable client base. You need to have an education first model. Education first. So how do you do that? Medicare 101 sessions, whether it be libraries, community centers, churches, senior events. You're trying to build authority in that local market, right? And transparency is the big differentiator for you, because the market is clouded. You have misleading ads. We have aggressive telesales people. You want to be the agent that clients trust when they just want clarity and honesty, right? So that's number one, position yourself as a local trusted Medicare advisor. Number two, lean into retention model and renewals. Because again, as the first one said, you're looking to work with a manageable client base versus chasing thousands of leads. So you need to really lean into your retention model to retain every client that you get in that marketplace in your manageable client base. And that's going to allow you to maximize your lifetime value of your client. If you've been in this business long enough, you understand that the long game is usually the best game, because it increases your lifetime value for every client you bring on. Not to mention, clients that you take care of in that fashion are more likely to send you friends and family and referrals, right? The odds that I'm going to get a referral off of someone that found me online and does a quick telesale with me is pretty, yeah, we do get referrals from those people, but they're limited. Like, they're certainly not enough to live on. I still have to continue to market and spend money because I can't just do that. But in a model like what I'm talking about here, in just your local agent, if you really lean into your retention and renewals, you're going to develop much happier clients with the higher lifetime value for each client. And those types of people are more likely to refer you business. In 21 years of doing this business, I can't tell you the number of agents that I've spoken to in my career that have said, I don't buy leads. I don't need to buy leads because I focus on increasing my maximum lifetime value and I live on referrals. That's all my new business is, nothing but referrals, and I run a retention model. Pretty simple. The other way that you can continue to do that is you really work hard on your annual coverage reviews. I think most of us do that. But again, if your focus is in building that local trusted advisor model, you really got to work hard on doing annual coverage reviews. And since you're trying not to spend a lot of money because you're working on being lean and mean, right, in a manageable client base, use a lightweight CRM that can help you with your relationships, making sure you have birthday reminders, plan updates, policy anniversaries, anything you can do to stay top of the mind. You don't need the most sophisticated one. You need something simple like DFY. $97 a month, boom, all that stuff's already built out for you. Just plug and play. Number 3, adapt to digital without overextending yourself. You don't have to get sick with it, but you do need to adapt to a little bit of digital work. You don't need to compete with the massive digital FMOs. You're not trying to compete with SelectQuote and some of these other folks out there, but you need a simplified digital footprint, so to speak, right? A very simple website, couple of good pages. Here's who I am. Here's what I do. Here's how you contact me. Make sure that it has a little bit of SEO in it to help those pages, even though they're simple, rank, right? Because again, we're looking at, I want to be the local guy. I want to be in this market, running this town. I am the Medicare go-to guy in this town. So you absolutely need to focus on some SEO so that people know, hey, I'm the guy in Timbuktu. So you need blog pages that talk about Timbuktu and what those Medicare beneficiaries are up against. You should probably be shooting some basic video about what life is like in Timbuktu, right? Because you're trying to position yourself in that space. So you need a simple digital presence without overextending yourself. Have a good Google business profile. Super simple. It's free to set up, not that hard. Make sure you have a Google business profile and certainly get your reviews. And again, part of that, again, I said this already, but just create some simple, authentic, short form videos that you can use for your Facebook page. That you can say, hey, I'm the trusted Medicare guy in Timbuktu, and here's what I have to say. Here's what the new thing looks like. Like if I'm an agent, let's just pretend right now that I'm in an area of Minnesota where that company UCare was super popular. Dude, I am going to be all over my Facebook business page talking about that. Hardcore. If I'm an agent in Minnesota, I'm going to be talking about this exit massively because I want to go find those people. I want them to know that, hey, I'm on top of this and I'm ready to help you. Simple stuff like that. And your goal with all of that is basically just to stay discoverable. You need people to be able to find you and see you as trustworthy without spending a ton of money on ads. Number 4, diversify within your own niche. And again, this is where some of the redundancy comes in. Like, this is a message that you've heard many, 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 many times, unless you just have peanut butter in your ears. But diversify within your own niche. What is your niche? Your niche is people that are 65 and older. Your niche is Medicare. At least based on the context of this article or what I'm talking about, it is, right? If you have other niches, that's a little different thing. But if you're in the 65 up space, if you're in the Medicare space, Medicare Advantage plans and Medicare supplements are not your only products. And PDPs are not your only products. I get it, man. PDPs are basically non-commissionable now. Nobody really wants to write them. But how can you position yourself understanding that? What are some other products that I could be writing? If I'm willing to create a system that I'm still willing to help you with your PDP and review it and take care of you, even though I'm not getting any comp, what can I do? How can I utilize that to leverage more leads for myself or build deeper trust with my client base? So you need to diversify your niche so you can offer complementary products that will help you make some cheddar or more cheddar. How do you increase your lifetime value of your client? other than through trust and keeping them on your books. You write them more products. You cover more risk for them. If all I'm ever doing is selling a Medicare Advantage plan and I let that person get out the door without offering them a hospital indemnity, without offering them cancer, without offering them home health care, or without trying to sell them final expense, like I don't get it. I don't understand. Like I'm allowing that person to go to the next agent that provides all that value. Why? It's not that hard. You're already talking to that person. It's the exact same audience. It's the exact same. I would guarantee you that there are agencies out there that could stop selling Medicare altogether and just sell complementary ancillary products and crush it. They're just going to have to be a little better at sales. They're going to have to be really good at lead generation. They're going to have to be really good at positioning the problem. But this is what it was like before. Before we had all this shit, when I first came in the business, it was just Medicare. We didn't have Medicare Advantage. We didn't have drug plans. We didn't have dental or vision plans. We didn't have any of those. We had original Medicare, which we didn't sell at all. You can't sell original Medicare. All we had was Medicare. We had one product, Medicare supplements. That was it. Supplemental cancer was out there, but it was still kind of an emerging, kind of growing market. There wasn't hospital indemnity. Certainly final expense was there. And that was how we made a living. We sold Medicare supplements. We positioned the problem. The problem is you have this really kick-ass 80-20 plan. See anybody you want, don't need referrals, but nobody wants to pay 20%. So you buy a low-cost Medicare supplement. And even then, only about 33% of Medicare beneficiaries would even bother buying a Medicare supplement plan. Because either A, we couldn't get to them fast enough, or B, some of them were certainly Medicaid folks, so they didn't need it or can't even sell it to them. But that wasn't the other 67%. That was a very small percentage, like 20-something%. But a lot of people were just running around with A and B and nothing else, because either they didn't have the right agent that could explain to them that, hey, you really do need a Medicare supplement plan and here's why, or nobody just ever talked to them about it. And certainly budgetary issues could be a thing, but like that was all we had to sell. Now we have all of these things that we can offer, and there are agents out there that aren't offering any of them. They're just like, man, just write that zero premium Medicare Advantage plan and move on with my life. Go find another one. You can sell them a hospital indemnity plan. You can add on some dental, vision, or hearing. You can stack dental. Like I helped a client recently. She had already wiped through her $2,000 max benefit on her dental options for her Humana MA plan. And then turns out she needed a fat root canal that was super expensive, and she didn't want to pay out of pocket. So I sold her an Emeritus plan. Stack your dental up. Like there's final expense. Again, like when I was, this just going back, when I was selling in the field before, sold Medicare supplements. That was how I got myself in the door. And when I would deliver the policy, because this was old school, this is back when everything was on paper, hand deliver policies, had to get a receipt for the policy delivery and send it back to the carrier. I would market final expense every time I did that. Right. And that's how I stuffed my pockets. But again, this is something that you have to do. This is number 4 on my list. You got to diversify with multiple products and get good. One of the greatest things about learning how to sell insurance that has a premium to it, one of the best things about learning how to sell premium is it is a transferable skill. If all you ever learn to do is be an order taker that writes zero premium Medicare Advantage plans, which I could probably train a monkey to do, ultimately, like your skill set can get wiped out like that. You're just an order taker. Go get the job at Starbucks if they wreck this marketplace. But if you know how to write premium, if you know how to position a problem and introduce a product that costs money and collect a check and have them say thank you to you after they cut you a check, that skill is transferable. And you can transfer that to any market within the insurance world. Whether you jump to life insurance, whether you jump to annuities, whether you just learn to sell supplementary health insurance, or whether you exit and maybe get into P&C or something or some other thing that you're selling. Learning to sell premium is an absolutely massive transferable skill. And for those of you agents out there that don't have it, you need to get off the schneid and talk to someone and learn how to sell premium dollars, because that is the best way that you can, 1, ensure your own longevity, but 2, in this example that I'm talking about, it's the best way that you can increase the lifetime value of every one of your clients. Because not only are you taking better care of your client, you're putting more money in your pocket on day one. You're increasing the lifetime value in the long term, and that's compounded is what I need to say. Because not only am I getting more commissions because I added on another product, but I'm increasing the retention of that client. I have clients that have 4 or 5 policies with me. They're never going anywhere. Like, I probably don't ever have to run any retention campaigns on those people because they are locked up. They're not going to let anybody get into their house or get into their head and talk to them about the kick-ass healthcare package that Tony Merwin helped them design. I'm not going to take that attitude. I'm still going to send them birthday cards, thank you cards, and call them during AEP to do some reviews. But like, that's the type of relationship that you're looking for in specifically in what I'm talking about here, right? Where I'm trying to be the independent guy that's fighting off the massive growth from these call centers, telemarketing people, and so forth. I just want to run my business in my town and make a good living. I'm not trying to be a millionaire. I'm trying to make, 400 or 500K in renewals, go skiing on Fridays, play some golf on the weekends, and have a good life, right? I'm going to catch these back up for you. Number 1, again, position yourself as a local trusted advisor. 2, lean into retention models. 3, adapt to digital without overextending yourself. And number 4, I just said, was diversify within your own niche through cross-selling of proper products. Number 5, prepare ahead of time for regulatory and commission shifts. It's going to happen. It's not like this is the only time it's going to happen. It's going to happen again in the future. Prepare yourself. And really, this number 5 is, I should have just read the book, Who Moved My Cheese, once a year. Go back and read that book and learn how to prepare yourself for when things get different, when things get hard, so that you can be one of the first guys on the job. Like, hey, here's problems coming ahead, Mr. Beneficiary. I'm already ahead of the curve. I'm already educated. I'm already very knowledgeable about it. Let me help you show you how you can avoid this or capitalize on this, right? Or mitigate some of this. So prepare ahead of time for regulatory and commission shifts, right? And this is important because, again, this goes back to the other things that I've said in this playbook already. Like, if you're focusing harder on retention, you're going to have to prepare for some of this, and you're also not going to get hit by it as hard. Start documenting some of your recommendations on a best interest process. What does the best process look like for your clients already? And start documenting some of that, because compliance and regulatory things could even get deeper, thicker, harder. So start to document some of those things for yourself in regards to, this is the process that I work on with my client. And if regulatory compliance things get heavier on you, you're already ahead of the game. Number 6, build a community with referral pipelines. I've already kind of talked about this a little bit when I talked about retention models. If you work really hard through a great retention model to take good care of your clients, you create a more loyal client. Ooh, it's already almost 10 o'clock. We got to hurry, which is going to send you more referrals, right? But build your community, partner with providers, pharmacies, senior citizen centers, nonprofits, and do constant workshops. Create a small referral network. Join BNI, start a BNI group, start a separate referral group. I've earned so many referrals from BNI in the short time that I've been in it. I've paid for BNI for the next 10 years. Like, it's covered. I don't even have to worry about my $1,800 I spend a year on BNI because I've already paid for it for about 10 years, understanding the renewal base of our business. So again, number 6, build a community. Number 7, and we're almost done, pivot points to nurture quietly. This is background stuff, right? If commissions get squeezed, start testing off some low-cost advisory fee services you can do, like RSSA, Registered Social Security Analyst, as an example. That's another way you could pivot. And I don't mean pivot like, oh, I'm leaving the Medicare space, I'm just going to be an RSSA now, and that's all I'm doing. No. I'm saying you're including something else in your business that adds value for your customers and allows you to charge a fee to capture some money and be profitable, because commissions might be getting squeezed in these other areas. Does that make sense? Right? So look for areas such as that where I can increase my revenue through little side streams that are simple, so that when I have challenge come to me, I have a little place I can pivot to in some form. And I think ultimately cross-marketing is the best one. But that is pretty much it. And then just learn to be a really good community influencer in there, and learn to look for ways that you can build your local mini brand, so to speak, so that if a call center floods that marketplace, clients are still going to choose you because you're the local trusted brand that everybody believes in. So kind of a bottom line note on this, and I'll finish up. I don't actually have time to get through the next piece of this, so I'll save it for next week. We'll dive deeper into this. But bottom line is that if you're an independent agent, bigger isn't necessarily better. Stickiness is, right? Stickiness is what's better. So you need to focus on relationships, retention, local presence, complementary products. Not complementary as in free, complementary as in supplementary or ancillary, secondary products. What's your primary product? What are your secondary products? And then what are your metrics? How often are you selling secondary or primary? Put that together, start working on that. And then keep your eye on regulatory wins in the future so that you can build pivot options and not get caught off guard. Pretty simple stuff. I'll dive some deeper into this next week because I've got more notes on it. I just ran out of time. But I appreciate you guys tuning in. Have yourselves an awesome week. Let's kick some ass, and I'll see you guys next week for Tuesday training. Adios.